Understanding financial statements, a guide for entrepreneurs. Understanding financial statements, a guide for entrepreneurs. As an entrepreneur, it is crucial to have a solid understanding of financial statements. Financial statements are essential tools for assessing the financial health and performance of your business. They provide a clear picture of your company's financial position and help you make informed decisions to drive growth and profitability. In this guide, we will break down the key elements of financial statements and discuss how entrepreneurs can interpret and utilize them effectively. The three main financial statements that every entrepreneur should be familiar with are the balance sheet, income statement, and cash flow statement. Each statement serves a unique purpose and provides valuable insights into your business's financial performance. Let's start with the balance sheet. The balance sheet is a snapshot of your company's financial position at a specific point in time. It includes three key components: assets, liabilities, and shareholders' equity. Assets represent what your company owns, such as cash, inventory, and property. Liabilities, on the other hand, represent what your company owes, such as loans, payables, and other obligations. Shareholders' equity is the remaining value after subtracting liabilities from assets. It represents the ownership interest in your business. Analyzing the balance sheet can help you evaluate your company's liquidity, leverage, and solvency. Liquidity refers to your ability to meet short-term obligations and pay off debts as they become due. By examining the ratio of current assets to current liabilities, you can determine whether your business has enough liquid assets to cover its short-term liabilities. Leverage is a measure of your company's debt levels and financial risk. It can be assessed by examining the debt-to-equity ratio, which compares the amount of debt your business has incurred to the amount of equity invested by shareholders. Solvency, on the other hand, assesses your company's long-term financial health and its ability to meet long-term obligations. This can be evaluated by analyzing the debt-to-assets ratio, which indicates the proportion of your company's assets that are financed by debt. Next, let's move on to the income statement, also known as the profit and loss statement. The income statement shows your company's revenues, expenses, and net income or loss over a specific period. It provides valuable insights into your business's profitability and the sources of your earnings. When analyzing the income statement, pay attention to different components such as gross profit, operating income, and net income. Gross profit indicates the profitability of your core business operations by subtracting the cost of goods sold from your total revenue. Operating income measures the profitability of your business operations after accounting for operating expenses such as rent, salaries, and utilities. Finally, net income represents the bottom line profit after considering all expenses, taxes, and interest payments. By examining the income statement, you can identify trends in your company's revenue and expenses, assess your profit margins, and pinpoint areas for improvement. It is crucial to compare your current income statement with previous periods to track your business's performance over time. Lastly, we have the cash flow statement. The cash flow statement tracks the inflows and outflows of cash in your business over a specific period. It provides insights into your company's ability to generate and manage cash, which is essential for operational activities, investments, and debt repayments. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. The operating activities section represents cash flows from business operations, such as sales, payments to suppliers, and salaries. The Investing Activities section records cash flows from the purchase or sale of assets, such as property, equipment, or investments. Lastly, the Financing Activities section includes cash flows from activities related to debt and equity financing, such as loans, dividends, or issuance of shares. Analyzing the cash flow statement can help you assess your company's cash flow generation, liquidity, and ability to fund future operations. By comparing the cash flow from operations with net income, you can determine whether your business is generating enough cash from its core operations. Additionally, examining the cash flow from investing and financing activities can help you evaluate your company's capital expenditures, debt repayments, and sources of financing. Understanding and interpreting financial statements is critical for entrepreneurs to make informed decisions about their businesses. By analyzing the balance sheet, income statement, and cash flow statement, entrepreneurs can assess their company's financial health, profitability, and cash flow. These insights can inform strategic planning, investment decisions, and financial forecasting to drive long-term success. Understanding Financial Statements, a guide for entrepreneurs, continued. In addition to analyzing the balance sheet, income statement, and cash flow statement, there are other important components of financial statements that entrepreneurs should be aware of. These include notes to the financial statements, which provide additional explanations and details about certain transactions or events. These notes can help provide clarity and context to the financial information presented in the statements. Another important aspect to consider is the use of financial ratios. Financial ratios are calculations that help interpret the information presented in the financial statements. They allow you to compare different aspects of your business's financial performance over time or against industry benchmarks. It is important to note that financial statements alone do not provide a complete picture of your business's performance. They should be used in conjunction with other qualitative and quantitative information to make well-informed decisions. It is also advisable to seek the help of professional accountants or financial advisors to ensure accurate interpretation and analysis of your financial statements. Understanding Financial Statements, a guide for entrepreneurs, continued. Furthermore, when analyzing the financial statements, it is crucial to understand the concept of accrual accounting. Accrual accounting recognizes revenue and expenses when they are earned or incurred, regardless of when the cash is actually received or paid. This is different from cash accounting, which records transactions only when cash is received or paid. Accrual accounting provides a more accurate representation of your business's financial performance and allows you to match revenues with the expenses incurred to generate those revenues. In addition to accrual accounting, entrepreneurs should also consider the concept of depreciation and amortization when analyzing their financial statements. Depreciation is the process of allocating the cost of tangible assets over their useful lives, while amortization is the process of allocating the cost of intangible assets over their useful lives. These non-cash expenses are recorded on the income statement but do not involve actual cash outflows. Understanding and accounting for depreciation and amortization is important for accurately assessing your business's profitability and determining its true cash-generating ability. Another useful tool for analyzing financial statements is trend analysis. Trend analysis involves comparing financial data from different periods to identify patterns, trends, and changes in your business's financial performance. By tracking changes in revenues, expenses, profits, and other key financial metrics over time, you can identify areas of improvement, areas of concern, and potential opportunities. Trend analysis can also help you evaluate the effectiveness of your business strategies and identify areas where adjustments may be necessary. Ratios such as the current ratio, quick ratio, and debt-to-equity ratio can provide information about your business's liquidity, financial leverage, and ability to meet its financial obligations. By benchmarking these ratios against industry peers or historical data, you can identify areas where your business excels and areas that may require attention.